I'm John Hanna for CityTV.net here in New York City, and we have Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good afternoon, Greg.
Well, good afternoon to you, John. How's it going?
Great, sir. It's kind of a little bit cloudy here in New York City, but so far so good.
Well, the markets are warming you up today.
That's good. Well,
yeah, the market. It seems like the markets. The earnings reports are coming out pretty decent, and 78. In fact, facts said that 78% of the companies are beating or exceeding expectations. So, that's good. And we're seeing the markets, like that good news. And so, even though there's quite a few signs of, the economy starting to, or at least softening up quite a bit, I'll touch base on some of those during our conversation today. But it seems like the market's wanting to continue to move higher.
There you go. That's good.
And like I said, John, if you may just jump in here, but corporate earnings, continue to do well, and kind of ignored the dicey economic reports last week, and has pushed the S&P back above 1,400. And this is even with a downgrade to Spanish sovereign debt, which is, and also a less than encouraging U.S. gross domestic product report. Even the global Dow was in positive territory. And a stand-pat stance by the Fed allowed bonds to kind of really remain fairly stable. But, you look at it year to date, we're up about 8.3% on the Dow Jones, 18% on the NASDAQ, and 12% on the S&P. And for the economic news, it slowed in the first quarter. The Commerce's Department's initial estimate of the GDP was 2.2%, which is substantially lower than the previous quarter's 3%. Consumer spending picked up 2.9%, which was higher than the 2.1% of the fourth quarter, but business spending was off. And so another indicator of a slowing economy was durable good orders, which plummeted 4.2% in March. And then we saw the real estate, housing, new home sales fell 7.1% in March, according to the Commerce Department. They point to the unseasonably warm weather that may have accelerated home sales, or some sales that would otherwise have occurred in the spring, since an earlier increase in February sales was revised upward. So we'll see if that holds true or not as we get into the summer months. And then it's the Fed Reserve's Open Market Committee met, and of course they saw some hints of softening in the U.S. economy. So they gave little indication of any potential post-QE2 actions in leaving interest rates intact. But really, a lot of the negative stuff was, the real estate continues, John, to be kind of an anchor while the boat's trying to run the race here. The economy, U.S. home prices hit their lowest level in almost a decade in February. The S&P Case-Shiller Index was down 0.8%, so 0.8% for the month, and 3.5% year over year. Get this, Atlanta's declined over 17.3% the last 12 months. 17 of the index's 20 cities reported lower prices. However, Phoenix, a bright spot here, 3.3% annual gain and its fifth consecutive monthly increase. So as we talk about overseas markets and what's going on there, we have to look to Spain. I mean, S&P downgraded the Spanish sovereign debt by 2 notches to BBB+. The rating downgrade could increase the country's already steep borrowing costs in the future. The S&P cited a lack of progress in reducing the country's budget deficit and likelihood that financial assistance would be needed at some point. It also imposed a negative outlook, which means further downgrades are likely. And their unemployment statistics delivered a second blow. They're at 24%, actually a little bit more than 24% unemployment. It's amazing. Then we had in Holland, another one bites the dust. Holland's prime minister and cabinet resigned after the coalition government failed to achieve budget cuts needed to reduce the country's deficit and comply with the Eurozone debt guidelines. And then, basically, we've got a pretty decent week as far as looking at this economic reports for this week, John. The unemployment data on Friday will be closely watched, especially in light of some of the softer economic data that's been coming out. Of course, additional earnings reports will vie attention with consumer spending data, and the Institute for Supply Management's manufacturing service reports will be coming out this week as well. And then finally, Thursday will bring an announcement from the European Central Bank's meeting, and that'll be closely watched. So, pretty busy week. The markets are responding as of this day, which is May the 1st, at approximately 12:15 p.m. Eastern Time. Most of the indexes are up around 1% as we speak. So the old adage of sell in May and go away may not apply this year. Reading lots of articles and commentary on that type of thing, most people say, well, you sell in May, traders start taking vacations, and you don't do anything until, everybody gets back from their vacations after the summer. But, with the election year coming up, the earnings are good, and, we have still a lot of stocks that are trading well off their highs. So a lot of activity and a lot of potential for even the summer months, at least in May. So sell in May may not be the thing to say.
Okay. Yeah. Well, I've read a lot about the that statement. Sell in May, come back when everybody's back from vacation. But like I said, might not be this year. So that's Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma. And I'm John Hanna for CityTV.net in New York City.